Hi, I'm Andrew Kushner, Policy Counsel at the Center for Responsible Lending. CRL provides nonpartisan research, analysis, and advocacy to create financial fairness and economic opportunity for all. A relatively new product on the market is Earned Wage Access or Early Wage Advance, commonly referred to as EWA. The EWA market nearly tripled between 2018 and 2020, reaching $9.5 billion in 2020. EWA borrowers tend to be hourly, relatively low-wage workers. We have found that while some consumers can benefit from EWA programs that are properly designed and regulated, consumers can also be harmed by unregulated novel financial products without guardrails. This potential for harm is particularly high with EWA because there are two very different products that companies market as EWA. This has led to confusion and consumer harm because one of those products is essentially a payday loan obscured by calling it EWA. The first type of product is called employer-integrated EWA. Many employers contract with an EWA provider to offer pay advances to their employees as a benefit. When these programs are free or very low cost and permit repayment only through payroll deduction without debiting bank accounts or delaying receipt of wages, they may be a better alternative than high-cost payday loans. But even these products are not without risks. They can lead to a cycle of repeat borrowing, like other balloon payment loans, which are loans where the entire principal is paid back on the due date. This may lead to difficulties meeting future financial obligations or covering large payments such as rent. Employer-integrated programs that charge fees are particularly concerning. In some cases, EWA companies offer consumers the option to receive their wage advance at some point in the future for free, or to pay a fee to receive the funds now, when the consumer likely needs the money. Even nominally low fees can quickly add up when consumers are stuck in a cycle of reborrowing. In the end, consumers may simply end up in a situation where they are routinely paying to be paid. Regulators have a duty to ensure that EWA products are not piling more debt onto families in financial trouble. And these products, whether offered free of charge or for a fee to employees, are clearly credit, because credit is simply an agreement to lend money to be repaid at a later date. They should be regulated as such to prevent misuse. Another completely different type of EWA product are programs that are called EWA advances by the finance companies that market them, but are not administered through an employer at all. These products are marketed directly to the consumer for a fee, typically through an app on their phone. Loans are due on payday and typically debited from the borrower's bank account. This type of lending is indistinguishable from payday lending. Policymakers should not allow lenders to evade state consumer protections simply by naming their product Earned Wage Access. Recently, the Consumer Financial Protection Bureau announced that it plans to issue further guidance soon about the application of the Truth in Lending Act, including rules requiring disclosure of interest rate or APR to EWA products. Such guidance is badly needed because some EWA companies do all they can to hide the true cost of their product. One especially problematic method that some companies use is to solicit tips from users for EWA advances that are nominally free. As we all know, tipping is a common practice in bars, restaurants, and coffee shops, but it makes no sense when the consumer is using a fintech app. No service worker is involved in making the loan. The tip goes directly to the company. Some EWA lenders report that these tips, which drive up the cost of the loan, make up high percentages of their company's revenue. A representative from the company Earn-In told Vermont lawmakers that tips make up some 40% of their revenue and that their business model would have to significantly change if the practice were regulated. The representative testified that Earn-In suggests a default tip of up to $11 on a $100 advance, a shockingly high cost for such a short-term loan. This indicates that the business model of these companies depends on making loans with true costs that are well above what they disclose or advertise. Consumer protections like the Truth in Lending Act exist because of the complexity of consumer finance and the difficulty in assessing loan terms for those who are not financial experts. Any type of lending should be covered by consumer protections so that terms are fair and not harmful and the true costs are disclosed to the borrower. All payments, including so-called optional payments made to the lender, must be included in cost calculations under the Truth in Lending Act. Whether payment for the loan is straightforward or collected as tips, the APR cost must be calculated and disclosed so that borrowers can compare the cost of EWA loans to other sources of credit, and so that lenders can be prevented from violating state usury caps. We recommend that states regulate all EWA products as the credit products they are, and that they require compliance with consumer protections that prevent debt traps commonly associated with predatory payday loans. The Consumer Financial Protection Bureau should also monitor and supervise EWA lenders to ensure that they are not harming consumers. Thank you for listening. Please connect with us at responsiblelending.org or follow us on social media.